Good morning, everybody. It's Hammer. Today is Friday, May 2nd, 2025. I, of course, am with Hammer Solutions, home of originator success, grab and go social, and more to come. Anyway, remember, you can join me live each and every weekday morning, 9:30 a.m. Eastern Time, broadcasting to you on Facebook and on YouTube here in the Smoky Mountains. It's a dark, dreary day today, and I think it kind of represents what's going on with the rate sheets. I've got that mood music thing going on. I'll have to show you guys. I'm looking out at the slider at the same time. So anyway, if you're here this morning, say good morning. If you're watching the replay, give me a hashtag replay in the comments. Don't forget to smash that like button, tag a little friend. If you're on YouTube, give us a thumbs up and hit that subscribe button. Remember, if you would like to be reminded that I'm going live, we send out a text message each morning. You can sign up at hmmr.io/reminder or use this cool QR code over here as well. Excuse me, if that works better for you. So anyway, let's say hi to the live folks. Who are my friends that are here this morning commiserating with me as rate sheets start to retract? Hold on one second. I'm going to mute. Just a little something in my chest here, not coming out. So anyway, James Mahan, good morning. Mike Brown, great to see you, sir, over on the YouTube. Make sure y'all leave comments. I appreciate it. Debbie Richardson, good morning. Mike Morano, great to see you. I got your email. Are you up in the Blue Ridge area now, or were you just staying here for a couple of days, or are you back already? Also, that is a wicked house in Highlands. Highlands is one of the most money areas. A lot of Atlanta money comes up into Highlands and Cashers. It's pronounced Cashers, by the way, not Cashiers, Cashers. But yeah, $49 million house. I could see that being in that area for sure, for shizzle. So anyway, good morning, Mallory Fotiadas, Angela Walters, Amy Blauser, Kenny Rivard. Good morning, Megan Lindbergh, Cindy Pulliam, Jared, Vincent, Deb Dickinson, Randy Leonhardt, Tom Stafford, Michael Love. Thank you all for joining me this morning. So today we're going to dive in. We're going to talk about the jobs data. It did come in stronger than expected. If you remember, Ron Siegel said, hey, what's your over-under on that yesterday? Many of us did think it would come in over, and it did. We'll talk about what that means for mortgage rates. I'm going to tell you a little bit about my cryptic text that I sent out this morning. I sent out a text reminding everybody to join that said, let me see exactly what it said. It said, yesterday was Michael Fronte, and today is REM. What the heck am I talking about? Come find out. I'll tell you what I was talking about in a minute. Morning, Hans Bruner, and welcome to Originator Success, by the way, my friend. So glad to have you as a member, and we'll have to catch up soon. Definitely have to catch up soon. So Michael Love, good to see you. So anyway, we're going to go over all of that. In fact, let's go ahead and let's jump in and get started. Let me pull up the screens. I'll tell you a little, we can talk a little bit about what happened yesterday, and then we'll come and talk about the actual jobs data. Good morning, Mike Schmolgen. Great to see you. So taking a look yesterday, mortgage-backed securities started to lose ground. See the shape here? Let me zoom in on this. All right. So taking a look here, you could see that we were going up, right? As these candlesticks move higher, that's good. We've seen this trend. See, this line is moving higher. And then yesterday, we can see that we had a big move lower. And if we look at the technicals, you could see that we crossed above the 200-day moving average on Wednesday, and we fell back below it yesterday. That's this purple line here. The red line is the 50-day moving average. Now you can see, if we look at this candlestick, let me put this on 1 month so you can really zoom in. All right. So when we look at these candlesticks and all this funky stuff here, let me pull this so it's next to me. There you go. All right. So when we look at these candlesticks, remember the tall, thin part is called the wick. That's why they call them candlesticks. Bottom part is called the tail. Yep. Just like sperm. And the middle part, the fat part, is the body, because just like me, it's fat in the body. So if it's green, it means we started at the lower end of the body and bonds ended higher. For mortgage bonds, you want them to sell for more money. The higher the premium, the better your rates. When we look over here at the 10-year Treasury yield, it's the opposite. Green means we started at a higher yield, but dropped lower. The reason is yield is an inverse of pricing. And we track the 10-year in yield, but we track everything else in pricing. So anyway, taking a look here, this purple line, you could see that we ended the day on Wednesday above that line. Thursday, we started up here. We got as high as up here, and then it came down. We got as low as down here, but it ended the day right on this red line. And that's where sometimes where you see the technicals come into play. It ended on the 50-day moving average. Now, if we had gotten better than expected, well, results, if we got better results, if we got worse than expected jobs data this morning, we would have looked for a bounce to go higher off of the 50-day moving average. But as I told you guys yesterday, the technicals would take a back seat to what are called the fundamentals. The fundamentals are the events occurring outside of the technicals. So the jobs data is the big fundamental. So the jobs data this morning, it did come in more jobs than expected. 177,000 jobs in April. The expectation was 138,000, and that obviously is higher. Now, the last 2 months, February and March, Wall Street Journal actually has it kind of broken down real nicely. February and March numbers were adjusted. They were revised down by 58,000. And that's normal to see adjustments for the previous 2 months. They're revised as you would think all the data is in, but it's not. So that's how they do that, right? So the unemployment rate, though, which is based on, remember, that's based on the household survey, not the business survey. So the household survey showed unemployment of 4.2%. And that means that all these people that were supposedly laid off from government jobs, and I say supposedly, I mean, I'm sure many of them were. I just don't know if all of them were. All this talk about everything, they're not showing up as unemployed. And remember, they could have taken a buyout, but not be looking for a job. They might be taking a break. Some of them, they might have a little bit of cash from that buyout, and they might just say, maybe I'm going to retire. So that's where, if you don't have somebody saying that they are actively looking for a job, then they're not actually unemployed. And yes, Julie says, I'm hearing more layoffs in the last week, so maybe we'll see jobs dropping in the next few months. Now, remember, you'll see that show up in the JOLTS data, the Job Opening and Labor Turnover Survey. As far as the number of new jobs created, we saw a lot less government jobs being created. Federal government layoffs were a drag on payroll. Federal government employment declined by 9,000 in April. So there's less jobs being created. There's less government jobs being created, but the people that are being let go, that's not necessarily going to show up in quite the same way. Also, a lot of people say that the government stuff isn't going to show up until the fall. So anyway, looking at this was not devastating to rates and pricing this morning. Let me make this all fit in the screen next to me. And now I can't get to, hold on. It moved the window. It didn't. Let me pull this over. Put that. Nah, you son of a dog. There it goes. Let me slide this over. Only 39 people on today. I'm surprised. Usually on a Friday with jobs data, we see more people on there. I don't know. I guess they don't want to know. So anyway, good morning, Brandy Brickler. Good morning, Allison Foy, Mike Tebow, Angie Kuznia, Jay Rodriguez, of course, Julie Lawrence, Randy Tico, giddy up, sir. Thank you, Frankie Floyd, for your kind words. Appreciate you, my friend. So anyway, as we take a look here, kind of where we are at this morning, let me make this a little bit smaller now, and we'll get into it. So all right. There's a few things that we have to take away. Just bear with me as I'm playing with everything. So what you're seeing here on this chart that I'm showing you with the candlesticks next to me, we kind of hit the peak. Now it's dropping down. The question is, will it continue to drop down or will we get a bounce? You can see that we've got some technical support here from the 25-day moving average. I don't really care about the 25-day moving average. I don't find that it gives a lot of actual definitive support. I think there's a lot higher chance we could drop all the way down to 99.15 in the 100-day moving average. We're at 99.35. That would only be another 20 basis points. It's really not that big of a move. Now, we saw the initial reaction. I'll put this on 1 day so we can see it all together. Okay. We came in. Actually, let's do 2 days so we can compare where we were. So yesterday, again, just to recap, Pricing came out around 99.70. There were reprices worse yesterday. Let me know in the comments, did you get reprices worse? Let me put that in the captions. Did you get reprices worse? There were definitely a handful. It wasn't really anything to worry about yesterday when we got reprices worse, because we needed to see where the jobs data came out this morning. But the reason you saw reprices worse, Will Patterson did, Christy Resor did. Good morning, Lisa. So as you see things kind of drop down here, we ended the day 99.55. When pricing came out, we were right around 99.80. So you're down about 15 basis points. Actually, that's 25 basis points. What am I thinking? So you're down about 25 basis points, which is pretty significant drop. Some lenders, though, pricing was a lot lower because it dropped right here right around 10 a.m. And that was because of the data that came out and the ISM data showing that the economy was stronger than expected. By the way, you'll notice I never even talked about the PCE data this week because it really hasn't mattered. So, but anyway, going back down here, looking at the jobs data yesterday, we ended the day. Things were pretty much like right in line with where they ended. We got the first move at 8:30. So, of course, the data comes in. We're at 99. Let's call it like 99.50. And then we're down about 15 basis points. It's been stable. Now, reprice risk on the day. Let me go ahead. I'm going to put this moderate. Reprice risk on the day is moderate. Sometimes we do see late afternoon falls for bonds after jobs data. So right now things have been pretty steady, which is good, right? So we know rate sheets this morning are going to be worse than yesterday. Yesterday they were, but they're right in that same line though. I mean, we're really not seeing much movement this week. You've got basically some small day-to-day rebate pricing changes, some tweaks in pricing, but you're not seeing rates move. Today you'll see same thing. I mean, when you're down 15, 18 basis points, that's not like, oh my goodness, rates are going to skyrocket up. It just means like, well, yesterday you were getting, $1,000 or it was going to cost you $1,000. Today you're getting back 200 or it's going to cost you 2,000. I mean, unfortunately it does worsen pricing, but it's not anything like devastating. But now pay attention. This is important. Okay. We have to take a look at what has changed. What has changed is the outlook on Fed rate cuts. The outlook on Fed rate cuts yesterday, it's flip-flopped. Yesterday, markets were pricing in a 60% probability that we would see a rate cut in June. Everybody agrees no cut in May, right? So, I mean, right now it's at a 98% probability there'll be no cut in May. Next week on the 7th, the Fed meeting. However, this is the big thing here. There is a big shift in expectation of cuts that could happen in June. It was 2-1 that we would see a cut. Now it's 2-1 that we won't. And that's a big outlook shift. Now, again, you could see that there's a little less of a kind of influence from that Fed rate cut perspective on what's going on with mortgage rates. But look at the 10-year Treasury yield, 4.27 now, which is a lot higher than that 4.17 we were at on Wednesday. That's quite a bit higher. And we want to watch this. Now, same thing, we can argue, take a look here. We're running into the red line, which is the 50-day moving average, the blue line, which is the 25-day moving average. We got the purple line here, which is the 200-day moving average. So you've got all of these different lines that are in. I like the thin candlesticks, but I wanted to make it a little bigger. All right, so take a look here. We're watching this 10-year Treasury yield. As far as the technicals go, this is as bad as it should be. Now, remember, when the yield goes higher, that's bad for rates and pricing. So the fact that we're getting this is support here. That would be stopping it from continuing to go higher. We need to see if this does hold up. The 50-day moving average is exactly where we're at right now, 4.277. The 25-day moving average is at 4.27. Again, the 25-day moving average, not a huge support or resistance level, but when it's converging and paired up with that 50-day, that does give some more. So right now we're going to cautiously float everything. All right. However, if we see signs of trouble this afternoon, make sure you lock it up. In case you're not signed up for our text alerts, you definitely want to be, because here's the deal. The Fed meeting next week on the 7th, and especially the press conference, going to be an even bigger deal now that markets are pricing in the expectation that they won't see a Fed rate cut. They're going to be looking, if we see this shift back and markets believe, okay, Powell has kind of opened the door in his press conference, the way he answers questions, we think we could see a rate cut in June, then you'll see mortgage rates can improve a little bit with that news. However, if Powell says, we don't see a reason to move, and this is how I think it's going to play out. Why does Powell need to move? Inflation continues to tick down. They think inflation could get worse based on what's going on with the tariff stuff, and they're not seeing signs of labor market weakness yet. This labor market data today supported the idea that the Fed does not have to take any action, that we're at or very near a neutral Fed funds rate. Neutral meaning it's not a drag on the economy and it's not overheating the economy. Arguably, the Fed is very near. Now, of course, Trump does not like that. He wants to see the Fed rate cut. I'm sure he will be vocal about that, as he's vocal about everything. But at the end of the day, it doesn't matter. So when we look at what markets are doing right now, we're at 99.36. We're down about 17 basis points. If we start to lose ground this afternoon, if we see bonds start to break down and give up and hit, where they go towards this 99.14, and we lose another 20 basis points, you're going to want to lock anything closing near term, possibly lock anything closing in the next 30 days, because what is our potential for improving from here? How good is that potential for improving? By the way, if you're not signed up for our text alerts, sign up for them, ratetextalerts.com. Use this cool QR code. If you're on your phone, take a screenshot. You can go back to your photos. The QR code will work. I think that's awesome. So keep all this in mind. As far as where things are at, Tom said, yeah, UWM. Tom, UWM, they do give it back quickly. I'm not even talking about their base pricing, but for changes, they're very aggressive at changes. They reprice quickly both ways. So, but anyway, this morning, it's unlikely we see a recovery from here. There's been an outlook shift. I'm just repeating myself at this point, but it's important that you kind of get it. We see an outlook shift that the Fed does not have to cut. Now, there's still plenty of signs of a weakening economy. There's also some good news that could come. China says it's assessing possible trade talks. China offers the hint of a potential thaw in trade tensions. China is assessing the possibility of trade talks with the U.S., the first sign since Donald Trump hiked tariffs last month that negotiations could begin between the two countries. China said it noted senior U.S. officials repeatedly expressing their willingness to talk. What a bunch of posturing this all is. But this could help things kind of speed up, the idea that we would see things. This is not necessarily fantastic for mortgage rates, though, but we would see bonds get a little bit of a benefit if you see stocks rally on this news. As you've seen recently, when stocks rally, you often see bonds grabbing their coattails right now. So keep that in mind. But as far as all of this goes, again, be very aware. We're cautiously floating because we don't want to necessarily overreact to the first punch, right? So yesterday, though, let's talk about my tune. So yesterday I was singing Michael Franti. Who knows who Michael Franti is? Let me know in the comments. Yes, I know Michael Franti, or no, I don't. Michael Franti, he's had a couple of commercial hits, but he's just a very positive singer, very light, fun music, usually love and kindness, kind of a hippy dippy type thing, but just a fun. And he's got a song called Sound of Sunshine Going Down. And yesterday I was singing a tune of like, hey, things are, we could see some better rates and things were better. I was just such a happy guy. And then today it's more like everybody hurts sometime. REM, right? I'd play you the real music, but then it wouldn't show up on YouTube and Facebook because of the copyright stuff. But yesterday's tune was The Sound of Sunshine by Michael Franti. Things were looking happy and good for rates and pricing. And today you're like, Hammer, why so wishy-washy? The jobs data has really changed the outlook. This jobs data, the reaction to the jobs data, really, because it really wasn't that big of a report when you think of it. It's not like we had 300,000 jobs created, but there, we know, everyone says they know the economy is weakening, consumer confidence is down, spending is down, yet as usual, what are the true signs of it? How do we see it? Yeah, Tim Klylov, thankfully, we're not nearly that bad. Remember that one? The end of the world as we know it. Thankfully, we're not that bad. In fact, it's not the end of the world as we know it. It's very much the same of the world as we know it, which is rates are going to stay in these ranges. Deb Dickinson knows Michael Franti. Deb, I'm going to see Michael Franti on next week, the 8th. Actually, because my wife's a big fan. So Tim knows him. Tom Stafford, some of us scratching our heads because MBS Highway seems to think we do have room for some pretty good price improvement. You know what? Listen, Barry, I don't watch Barry, so I don't know what Barry is thinking. This is how I'm interpreting everything. It's like reading any headline, Barry is super bright and has won tons of awards and et cetera, et cetera. Listen to what he has to say. I don't think we're going to see price improvement unless we get a shift. You'd have to, in order to see that happen. Yeah, UWM changes every 7 ticks. Well, you're talking ticks for bips, not ticks for 30 seconds. But yeah, so anyway, to go back to what Tom was saying, and like what Barry is seeing, I don't know why Barry would be seeing it again. Yesterday, I saw signs of it for improvement. Today, there's a very strong reaction. You have to pay attention to stuff like this because it doesn't matter what they're saying in the headlines. This is the reality. This is what's actually being done and where the money is going. So it's keep that in mind, right? So we're seeing a big shift here. And again, I don't think, let me see, where did we get the PCE data, PCE inflation data? It was all like blah, blah, blah. Consumer spending jumps, key inflation. Again, I didn't even talk about the PCE because it wasn't going to have much of an effect. I was looking for the PCE, the actual numbers. Here it is. So when you look at the PCE data, we want the core. Month over month came in slightly higher. And that's really great. And then PCE year over year came in right as expected. So that's why I didn't really bring up much about that one. But Tom said it was Barry's son, and yes, it was yesterday. See what they say today. They might change the outlook today. There was, like I said, and that's why we're joking around about the songs. I was singing a similar tune of possibility of improving yesterday, and that things looked really good. The reaction today to this data is stronger than it should be. Thankfully, we're not seeing a lot in mortgage-backed securities. They're not really off that far. But look at this 10-year Treasury yield, man. We're at 4.27. We were at 4.17. Yesterday we were at 4.27 or 4.21, 4.22. So we've seen quite the bounce. And if we don't, hopefully it holds steady. But what do you think next week will bring? Well, what do you think Powell and crew are going to say that makes markets believe, hey, they're going to ask him about the economy. If Powell, we'll talk more about it. It's been 24 minutes, y'all. I'll talk more about it next week. So, but yeah. So anyway, always love to hear what Barry has to say, y'all. Was he locking or floating going into the jobs report this morning, since y'all are bringing it up? I'm just curious. I was floating into it. So, but let me know in the comments. Curious. And in the meantime, y'all have a fantastic weekend. What are you guys doing? What are y'all doing this weekend? I'm going to do some barn work. I am excited. I can't wait. It is May. I want to be in the new barn by July. sometime in July is my goal. And so the electrician's coming again tomorrow to be tying some stuff up there. And I am excited to be getting things going. But keep me posted. So let me know what you guys are doing this weekend. Thanks, Tom. He was floating into it too. Yeah. So that shows I like to know, because I mean, when we disagree, there's usually obviously a big reason behind it for them on what they think. So, all right, my friends. Well, you guys, let me know what you're doing on this weekend. Next weekend, or actually Sunday, I'm going to Nashville. I will be coming to you on Monday from Nashville. Monday's going to be a little bit rushed, because I'm going to be at my mastermind group. I am part of something called Founders Board, which is Ryan Dice and his business partners. It's their mastermind group. It's their company is scalable, and it's a good business thing. So, doing open house on Sunday, Debbie. Good luck. Good luck. Tom, can I send us into the weekend by showing you the cash spread? Actually, I put it in the safe. I was lazy the other day. However, I'll make you a millionaire. Here you go. Here's $1 million. There's $1 million. There we go. That's better. There is $1 million. And besides, I won't have that money come Monday, because the reason that I carry a lot of that cash is because I'll take care of my electrician in cash. Because the big, beautiful bill, how many of you laugh at that like I do? The big, beautiful bill has not gone out. I applaud Trump following through on the promises of not taxing things like tips and overtime. I don't agree with it, but then again, W-2 employees get totally beat up anyway, and cash businesses, servers and stuff, used to be a lot more cash and tips, and now there's not. But again, I know it's not a fair world. I'm not saying it's not fair. I mean, like, I've got my kids that they work jobs where they're getting a salary and they get totally killed in taxes. And it's like, well, so if somebody else gets overtime, I'm thinking, I might actually have to adjust the way that I pay my employees and put them on an hourly wage, and then give them overtime, so that, I mean, how could I not put them in a position to get better? We'll see where all this goes. I'm curious. So, Mike Tebow driving home from Myrtle Beach. Well, Myrtle Beach is a hell of a lot better than Michigan, ain't it? It's finally just starting to get warm out there. So, all right, my friends, I'll see y'all later. Have a fantastic weekend. I'll see you Monday from Nashville. Bye.